In our two-part webinar on not-for-profit considerations, we discuss recent and future changes in the area of reporting and regulatory compliance and things that you should think about now. In part one of our webinar, we focus on recurring practical challenges with implementing the new revenue standard AASB 15 and the not-for-profit income standard 1058. Identifying whether the contribution you receive is enforceable and contains sufficiently specific performance obligations, and therefore which revenue or income standard to apply, continues to be challenging. In our webinar, we've worked through an example where a not-for-profit entity receives a capital contribution and in return promises to acknowledge that contribution by providing say for example, a plaque. And we assess whether that plaque is incidental to the arrangement and whether it's sufficiently specific or not. We also explore whether having deductible gift recipient status means that all donations received by such an entity would be within the scope of the not-for-profit income standard. The other practical implementation issue that we spend some time talking about is, having concluded that the arrangement is within the scope of AASB 1058, we explore whether there is a financial liability that should be recognised. And we illustrate this issue through an example involving a foundation who receives a donation and as part of that receipt promises to pass 95% of that donation on to another not-for-profit organisation. In that example, we explore the extent of discretion that the foundation has with respect to distributing those monies and whether there is a financial liability for 95% of the donation. And more importantly, whether this means that the income that the foundation receives should be recognised net of the distribution at 5%, or whether it should be recognised gross at 100% of the donation with a 95% donation expense. While we do illustrate this issue using the example of a foundation, consideration whether you have a financial liability will exist in all arrangements where you do receive some funds and make a promise to pass some of those monies on to a third party or to spend it on a third party. Taking a step back and looking a little bit more broader now at performance reporting. Recent royal commissions and media scrutiny on the ageing and disability sector has demonstrated the increased desire for more transparent reporting around the use of government funding. And also there is increasing demand from donors and funding bodies and the general public on outcomes achieved by not-for-profit organisations. We're also finding that more generally across the globe, there is a trend for, improved and more transparent corporate reporting to all stakeholders. And recently we've heard that the AASB is keen to restart their project on service performance reporting, which they originally issued an exposure draft on in 2016. Given this development, in our webinar, we talk about the steps that you can take now to prepare for performance reporting. By providing tips on how you can improve the structure and content of your financial statements, to how you can start incorporating elements of integrated reporting in determining your performance metrics. We are also observing increased ATO scrutiny on your sector. And with this, we do spend some time reminding ourselves of the in Australia requirement of a deductible gift recipient and income tax exempt entity status. Also, back in I think the 2009 federal budget, you'll recall that there was an announcement of some $2.9 million funding boost to the ACNC to boost their field-based compliance review. That, along with the increased scrutiny on your sector, demonstrates how important it is to maintain your charitable registration and review your compliance with the ACNC governance framework. So that's our summary of part 1 of our webinar. A reminder that part 2 will be held on the 20th of April, and we hope that you'll join us for that. Thank you.